When it comes to investing, there's no shortage of theories, approaches, and ideas. Hi, I'm Chalekian, the CEO of Lake Avenue Financial, and your guide to help you navigate through your financial journey. In this course, we're going to simplify the investment process by reviewing 5 smart strategies and show you how they can help guide your approach to the financial markets. This should help you develop an overall strategy tailored to your goals, risk tolerance, and time horizon. Now, while there is a lot to learn about investing, understanding a few of these sound strategies may be enough to help you get started. Let's begin. While there are many sound investment approaches, we're going to review only 5 that have the potential to benefit the greatest majority of investors. Understanding these strategies could help improve your portfolio's long-term results. First, don't time the market. Missing a few of the market's best performing days can reduce your portfolio's overall return. Second, review your asset allocation. Asset allocation is the process of dividing your investment dollars among various asset classes. While that may sound simple, it's a bit more sophisticated than you may think. Asset allocation is an approach to help you manage investment risk, but it's not a guarantee against investment loss. Third, choose appropriate investments based on your individual situation. There's a wide variety of investment options available in the marketplace. Selecting the appropriate tools for your specific goal is crucial. Fourth, remember dollar cost averaging. In short, dollar cost averaging is a process of investing a fixed amount of money in an investment vehicle at regular intervals, typically monthly, for an extended period of time, regardless of price. Lastly, consider rebalancing your portfolio. Over time, a portfolio's risk profile may adjust due to the performance of certain investments. Rebalancing may help a portfolio better reflect an investor's goals, risk tolerance, and time horizon. We're going to discuss all 5 of these strategies in detail. Let's take a look at market timing. Market timing is an attempt to follow one of the oldest sayings in investing: buy low and sell high. As this illustration shows, perfect market timing would require you to buy when the market bottoms and to sell when prices near their peak. However, it's difficult to know when the market is about to turn higher or lower. All too often, investors buy as the market is reaching its peak, when enthusiasm is at its highest, then sell after a steep drop. Investors who attempt to time the market can sometimes have success over the short term. However, over the long term, it is a very difficult strategy to follow. The cost of market timing can be high. In this chart, you can see that the Standard & Poor's 500 Composite Index, better known as the S&P 500, had an average annual return of 10.4% for the 20-year period starting January 1, 2005 through December 31, 2024. However, investors who missed the 10 best trading days during that period had an average annual return of 6.1%. To put that into perspective, if an investor put $10,000 into an S&P 500 index fund on January 1, 2005 and left that money untouched for 20 years, it would have grown to $71,750. But if they tried to time the market and missed the 10 best market days, that would bring their portfolio value down to $32,871. That's a difference of over $38,000 on that $10,000 original investment. More than half of the value disappears if you timed it wrong. Investors who missed the 20 best trading days had an average annual return of 3.5%, and investors who missed the 30 best days had an average annual return of just 1.3% over that same time frame. Now, can you guess what the average return was for those who missed the best 60 days in 20 years? It was actually a negative 3.7%. That means that if we use my previous example of a $10,000 investment in 2005, it would be worth $4,712 by the end of 2024, wiping out more than 50% of their original investment. Now, are we suggesting all investors should stay in the stock market all the time? Certainly not. However, this snapshot in history shows that missing the market's best days can have an influence on your overall return. The next investment strategy that has the potential to influence a portfolio's overall return is asset allocation. Asset allocation is an approach to manage investment risk by diversifying a portfolio among major asset classes such as stocks, bonds, and cash alternatives. Stocks, bonds, and cash alternatives have different levels of risk and potential return. Over any period of time, one asset class may be increasing in value while another may be falling. Both asset allocation and diversification are approaches to help manage your overall investment risk. but keep in mind that they do not eliminate the risk of a loss if prices decline. One landmark study showed that up to 91.5% of the performance of an average portfolio is determined by how the assets within that portfolio are allocated between different investment classes. Only 8.5% has to do with specific securities chosen. So you can see why the proper asset allocation of your portfolio is very important. Asset allocation can have an influence on a portfolio's overall return. Here's a look at each major asset class. Cash equivalents are investments that are readily convertible into cash. Some consider money market funds a cash equivalent. Keep in mind that money market funds are not insured or guaranteed by the FDIC or any other government agency. Fixed income tools are vehicles that offer fixed payments. Some fixed income investments have contract limitations, fees, and charges, including account and administrative fees, underlying investment management fees, and mortality and expense fees. They may also have surrender fees if you withdraw the money in the initial years. Bonds are debt investments that are issued by federal, state, and local governments, government agencies, and corporations. Those who invest in bonds receive interest payments until the bonds mature, at which time their investor's original principal is repaid, barring a default by the issuer. The market value of a bond will fluctuate with changes in interest rates. As rates rise, the value of existing bonds typically falls. If an investor sells a bond before maturity, it may be worth more or less than the initial purchase price. A stock is a security that represents the ownership of a fraction of a corporation. The units of a stock, called shares, entitles the owner of a stock to the portion of the corporation's asset and profits equal to how much stock they own. With stocks, the return and principal value of stock prices will fluctuate as market conditions change. In shares, when sold, may be worth more or less than their original cost. Finally, we have more speculative investments. These types of investments can be attractive due to their high potential return, but high returns also can have severe downside potential. These types of securities may not be suitable for everyone. With a basic understanding of asset classes, the next step is the selection process, allocating assets among the major classes. This can become very confusing for investors, as within the major asset classes there are thousands of investment options. As a new investor, you may wonder where to begin. I found that the best place to start is to consider your investment goals, risk tolerance, and time horizon. If your time horizon is less than 3 years, certain asset classes may be more appropriate than others. If your time horizon is 20+ years, you may be able to consider a wider spectrum of asset classes. When you look back at history over the long term, it's easier to identify the top performing asset classes. If you recall, in our previous example, $10,000 invested from 2005 to 2024 grew to over $71,000 if you were invested in stocks, over $18,000 if you've invested in bonds, and over $14,000 if you remained in cash over those same years. But when you look at the short term, the top performing asset class can change from year to year. In 2022, the stock market lost 18%, while cash had the best rate of return. Then in 2023 and 2024, the stock market recovered its losses. As you can see, over any 1-year period of time, one asset class may be increasing in value, while another may be falling in price. By allocating assets among investment classes, investors are looking to generate the highest potential return based on their investment goals, risk tolerance, and time horizon. However, asset allocation is an approach to help manage investment risk, but it does not guarantee against investment loss. The next investment strategy we will be covering is dollar cost averaging, which involves a systematic investment of a fixed amount at regular intervals. Instead of trying to time the market, you're investing on a regular schedule. That means you're automatically buying more shares when share prices are lower and fewer when they are higher. In this example, let's say you are investing $500 per month into an investment whose price per share was falling from $30 a share in January to $25 in June. By the end of the 6 months, you would have invested $3,000 and purchased 109.5 shares. A bit of quick math reveals that your average cost per share, the price you actually paid, was only $27.40, a bit lower than the $30 a share price you would have paid had you bought all $3,000 worth in January. If you had purchased all the shares in January, your $3,000 would have bought you 100 shares. So in this example, using a dollar cost averaging strategy while the share price was declining helps you accumulate 9.5 more shares of this investment. Now let's see if the same strategy works in a rising market. In this example, let's say you are investing the same $500 per month into an investment whose price per share was rising from $30 a share in January to $35 in June. By the end of 6 months, you would have invested the same $3,000 and purchased just 92.6 shares. Your average cost per share in this rising market example was $32.40, a bit higher than the $30 a share price in January, but still lower than the $35 a share in June. Just like in the previous example, if you had purchased all the shares in January, your $3,000 would have bought you 100 shares. But in this scenario, using a dollar cost averaging strategy, while the share price was increasing, you accumulated 7.4 less shares of this investment. Now, keep in mind that the markets and share prices don't only go in one direction month to month. In a typical market, they will fluctuate up, down, and sideways. For many who are afraid of investing in stocks, dollar cost averaging is a way to ease into the markets. An investor is looking to benefit from what is called averaging. This strategy helps maintain a disciplined investment approach despite any nerve-wracking swings in the financial markets. When others may be tempted to give up, investors who practice this strategy will invest a specific amount at regular intervals without being phased by these fluctuations. The final area to cover is rebalancing your portfolio. In this illustration, an investor created a conservative portfolio. The investor's $100,000 portfolio was allocated 60% to cash equivalents, 20% to bonds, and 20% to stocks. For the 20-year period ended December 31, 2024, this hypothetical portfolio generated an average annual rate of return of 4.2%. The investor's initial $100,000 investment increased to $227,000. The portfolio's best year was 2019 with a gain of 9.44%, and its worst year was 2022 with a loss of 5.43%. In this illustration, an investor created a growth portfolio. The investor's $100,000 portfolio was allocated 80% to stocks, 10% to bonds, and 10% to cash equivalents. For the 20-year period ended December 31, 2024, this hypothetical portfolio generated an average annual rate of return of 7.86%. The investor's initial $100,000 investment increased to $452,000. The portfolio's best year was 2019 with a gain of 26.3%, and its worst year was 2008 with a loss of 28.84%. As you can see from the previous two example portfolios, there is a wide range between the best and worst years. That's why it's important to rebalance your portfolio to match your risk tolerance. Balancing is not a one-time event, it's an ongoing process. That's because time can change your portfolio's risk profile. If overlooked for a long period of time, a portfolio may take on a completely different degree of risk. For example, consider a hypothetical portfolio which started on January 1, 2005 with a balance of 50% bonds and 50% US stocks. What did the portfolio look like on December 31, 2024? It would have shifted to 26% bonds and 74% stocks. That's more aggressive than the original intent, and the investor is 20 years older. Periodically rebalancing your portfolio may help it continue to reflect your intent and risk tolerance. Here's an exercise to get you started. It's a valuable look at where your current money is. You've just seen a series of charts that showed hypothetical portfolios, but now it's time to think about your own investment mix and what that looks like. Ask yourself, where's my money invested right now? Make sure you account for all your investments. That would include your rainy day funds, the money set aside in your retirement plans, other investments, etc. Many find this exercise to be a bit difficult. They've never thought about their investments by asset class before, let alone try to figure out how well balanced their investment approach is and whether it's consistent with their investment objectives, risk tolerance, and time frame. Yet it can be critical. If you don't know where you are, how can you map a path to where you'd like to be? Putting together a sound investment strategy can potentially make your investment efforts more effective, but it doesn't end there. Effective investing requires an ongoing effort, and there's a lot more to learn. Here are some questions that arise at different stages of life. You may have a growing family and wonder, what's the fastest way to amass enough money to buy a home? Or maybe you are in retirement and ask, how do I shift my investments to generate more income? Or you're a small business owner and want to know, How should my business affect my investment decisions? The answers will depend on each unique situation. Regardless of the investments you select, following smart investment strategies is an important step towards pursuing your long-term goals. At the Academy, we love helping people just like you develop and implement sound investment strategies. We'll assist you to evaluate your financial situations and provide our community members with tools that can help them make informed decisions. Lastly, I have included a link to a simple questionnaire that will help you understand your current risk tolerance and match that to an appropriate asset allocation mix. You can find the link in the show notes. You'll also find a link to join the Academy, where you can get access to other great courses just like this one. I hope you found this information helpful. If you have any questions or comments, please feel free to put them below. We would love to get your feedback. Thanks for watching.